In this video, we're going to briefly discuss long-run equilibrium and perfect competition. So in the previous video, we talked about short-run equilibrium. Now we're going to talk about long-run equilibrium. So we're going to need three conditions to be in long-run equilibrium. Three conditions. All right, so condition one is that firms must be maximizing their profit. This is essentially just saying that they must be producing where marginal revenue equals marginal cost. Condition two is that firms are making zero economic profit. Which is essentially saying that we're going to have this point where marginal revenue equals marginal cost equals the average total cost. And let's just scroll down a little bit if we can. And three, firms cannot increase their profit by changing the size of their production facilities. Facilities. And this is essentially saying that we must be at the minimum point of our long run average cost curve, which is essentially saying that now, putting these together, we need marginal revenue equals marginal cost equals this average total cost equals the minimum point of our long run average cost curve. Okay, so let's draw this equilibrium out. It's going to look a lot like our short run equilibrium with zero economic profit. We just have one extra curve to draw in. Alright, so here's our industry diagram. Here's our firm diagram. Price and quantity. Price and little q. Okay, so the supply curve, the downward sloping demand curve. We have the market clearing price and quantity in our industry. So I should label that the industry / market. This is our firm over here, the small q. Some of our firms take the industry price as given. So here's our demand equals marginal revenue equals price. Here's this marginal cost curve we've been drawing. So it's downward sloping at the beginning because of increasing marginal product, and then that diminishing marginal product kicks in and it starts to increase. Our conditions mean that we need zero economic profit. So marginal cost has to pass through this minimum point of the average total cost at exactly this P star. And then we just need one more curve, which is this long run average cost curve. Hopefully that just fits in on the screen. So we have to be the minimum point of this long run average cost curve. It looks a little bit below, but let's just pretend it's at that minimum point. And so we're going to be producing at this Q star here. So we're maximizing our profit by producing where marginal revenue equals marginal cost. That looks a bit ugly right there, so let's just draw that again. We're producing our marginal revenue equals marginal cost. So this first condition is satisfied. All firms are making zero economic profit. So if this is a representative firm, it's making zero economic profit because marginal cost equals average total cost equals marginal revenue, or the price. And this third condition is we have to be at the minimum point of our long run average cost curve, which is meaning we can't change the size of our production facility or factory or whatever you want to think about and reduce the average costs, which means that we're at the minimum point of this long run average cost curve. So this is what a long run equilibrium is in perfect competition.